I'm Ty. I'm coming to you from my garden. This is actually the potting shed because it's October in Portland, Oregon. And in Portland, Oregon in October, it's rainy and messy. We've actually had hail this week. So we're doing the fall cleanup and getting the last of the harvest done. And I wanted to take a break from that and spend some time here shooting this video to talk about some tax guidance I saw come through recently on advanced payments. And I'll skip to the end of this just to give you a quick summary of what I'm going to talk about, and that is that the IRS has issued guidance related to advanced payments that indicates they may require the extra logistics of filing what's called a method change for what I think in most cases will be just a technical change in the method and not really be substantive in terms of a change in how the company actually recognizes income. So with that, let me give you some background on this topic. And you know, this is October of 2018, so some of this may be well settled if you're watching this video a year from now, but I think some of the basic, some of the underlying concepts about advanced payments and the history of accounting for advanced payments and unearned revenue might be interesting to you just the same here. So advanced payment is the tax technical term in the statute. It's the statutory term for what we call in accounting, financial accounting, what we would call unearned revenue or deferred revenue. And so what that is if you're running a business and a customer pays you ahead of delivering your product, or they pay you before you perform the service, then we say you haven't actually earned it yet. That's the accounting terminology. You haven't earned the income yet, and therefore that payment that you received in advance is in accounting terminology would be considered unearned revenue or deferred revenue. And we would normally in accounting, for financial accounting, we would park that on the balance sheet and we would not recognize that as income until you earned it. So we would wait till you actually delivered the product, or we'd wait until you perform the service, or whatever that earning mechanism is. And then we say we amortize the unearned revenue by recognizing all of it or part of it as revenue as it's being earned. That's the normal accounting treatment if you're doing what we call accrual accounting. So that's the accrual accounting concept. But the tax law doesn't use the phrase unearned revenue or deferred revenue. The tax law uses the term advanced payment for the same thing. So if you receive a payment in advance of earning the revenue, then it's an advanced payment under tax law, under the tax law lingo. And the statute that deals with this topic is Section 451, which deals with what is income on an accrual basis. And the thing to understand about accrual accounting for tax purposes is that accrual accounting on the tax return is not always the same as accrual accounting in your books or for financial accounting. So it's still the case that even if you're an accrual method taxpayer and you keep accrual books, you could still have differences between your accrual books and your tax return for issues like unearned revenue. This would be one of those common issues. So the treatment of advanced payments, or what the statute under Section 451 says, is that an advanced payment is taxable. The plain language of Section 451 historically said that if you receive a payment for what is to be income and you have a fixed right to that income, then you would have income immediately. There's no deferral. There's no deferral mechanism contemplated in the plain text of Section 451 as it was written. However, we got some regulatory relief on that topic in the sense that because we are deferring it for accounting purposes, it's easier when we can keep things the same between accounting and tax, even though they aren't always the same. It's always easier if we can keep them the same. And also, of course, if we didn't really do the work yet, we haven't earned it yet, and we have yet to do that, there's a sense of fairness that seems like, well, why can't we wait and pay taxes when we earned it, so to speak, right? And so we got some regulatory relief on that in the form of historically of a revenue procedure and of a treasury regulation that both came to this conclusion in different ways, that you could defer revenue for a limited period of time if you did so on your tax return, or if you did so in your financial accounting. You could go ahead and defer revenue for a limited period of time, not forever though. I mean, you can't defer revenue for the same amount of time that you might in your books still. There were limits. So for example, if you were performing services, you could defer revenue up to 1 year, but you couldn't go beyond that year, kind of thing. So we have this what I'd call regulatory guidance, revenue procedure and treasury regulation that dealt with deferring revenue if you received an advance payment either for services or for the sale of product. So what changed on this? Well, this is the thing that's maybe interesting or perhaps aggravating, is that the substance of tax policy hasn't really changed on this, but the 2017 Tax Act, the one that was passed in December of 2017, added a statute, 451C, which put into statute this idea that you could defer income on advance payments if you met criteria. And again, you could defer it for a limited period of time. And the mechanics of 451C are very similar to the mechanics of the prior regulatory guidance. So what I mean by the mechanics are similar, and I'm not going to get into a detailed analysis of 451C here. I'll put that on deck for a future video. But generally speaking, many companies, many businesses will have exactly the same result under the new statute that they had under the old regulatory guidance. So park that thought in your head that income, essentially, the calculation of income may be the same. In most cases, it should be the same between what they did under the regulatory guidance and what they would now do under the statute. So here's the kicker on it. There's another code section 446, which deals with accounting method changes. And generally what happens with accounting method changes is if you switch on your tax return the way you account for something, you have to file for an accounting method change. Now, some accounting method changes are automatic changes where you just file a form and you can presume that you get the method change and move forward. Other changes require that the IRS actually gives you permission for the method change. So why this topic came up is because the IRS has recently, I'm sitting here again in October of 2018, the IRS has recently put out a regulatory guidance that basically is saying, well, we're going to get rid of the old regulatory guidance. They said, look, the code section that we now have, the new statutory guidance, basically overrides the old regulatory guidance. We don't need the old regulatory guidance, so we are going to remove it. We're going to revoke it. And then they also note, well, that part, let me pause for a second and point out that there's nothing particularly surprising or problematic with that particular part of what the IRS has announced, because it's like, well, yeah, the new code section does override it. So yeah, it's cleaner to not have regulatory guidance sitting out there that we don't need. It might just be confusing. So yeah, good idea. Let's get rid of that old, why have more regulation that's not even active anyway? Get rid of it. Yeah, makes sense, right? The part that is the part that I think will be somewhat aggravating for some of us is that in talking about that, they bring up this accounting method issue under Section 446, and they point out, hey, if you are deferring revenue under the old regulatory guidance and now you're going to defer revenue under the new code section, you're technically deferring it under two different tax laws. So that would qualify for an accounting method change. Well, okay, yeah, I guess technically, I suppose I can see that idea, but the kicker on this is that, like I said earlier, there may actually be no real change in income. So we're talking about filing for an accounting method change from one method to another, just for technical reasons. I'm not sure exactly where this is going because the IRS is asking for comments. So maybe this will get resolved, or maybe there's other pieces to this that I haven't thought of that'll alleviate what sounds like an extra technical burden, but that's it. That's what I wanted to bring up. I thought it was interesting, potentially aggravating, newsworthy, something to throw out there for you all to know about or think about. Perhaps if you're on the entrepreneur side of this, ask your accountants about if that's something that you're going to need to deal with. But it will, by the time many of you watch this, like I said, if you're watching this like a year later, it'll already have been resolved and a transition plan will have already been put in place. So I think what I really hope many of you get out of this is understanding when you hear the term advance payments from a tax person or from tax literature, what that means and how it relates to financial accounting. You kind of understand the history on the advance payment story, and that may help you understand what the actual rules are now that we're living under a new statutory rule with regard to advance payments. Okay, well, that's it for now. I'm going to head back out and do some more cleanup for the fall and getting into winter and planting some bulbs and things like that. So I'll talk to you next time. Take care.